Hello again. This is Amanda Czosek, a partner at Teboda Associates. The first quarter was tumultuous from a news perspective, but the markets hardly lost a beat. So let's review the first quarter briefly, and then we can discuss what we can expect in the months ahead. So the market has been grinding steadily higher since we started this year, with the election now in the rearview mirror and vaccine supplies steadily increasing and being distributed. The worst of the coronavirus was beginning to feel like it was behind us as we ended the fourth quarter. Much of the post election rally was driven by vaccines and hopes that we would reopen soon. We did have a second spike in what typically would be the height of the cold and flu season, but that didn't really produce any meaningful restrictions or shutdowns, so the market really didn't take notice. Even in the riot at the Capitol in early January, it really didn't shake up markets too much. There was a brief hiccup at the end of January as the markets wrestled with the GameStop Robinhood short squeeze, but just as quickly a new focus emerged, the massive $1.9 trillion stimulus, which finally passed just at the beginning of March. So, as we are closing in on the stimulus deals, comments from Federal Reserve Chairman Powell regarding inflation and the Fed's continued dovish stance with respect to rates kind of spooked the markets, resulting in a return of volatility by mid-March. The markets were higher as we closed out the quarter with the Dow cresting over 33,000. The Nasdaq, however, took a hit and was not a happy place to be because rates really climbed over that 1.5% on the 10-year Treasury. This was primarily due to a rotation of sorts as high-flying internet stocks, which had led much of the rebound in advance in 2020, veered into correction territory. We also saw that a transition from stocks with high beta, weak fundamentals into stocks that were more solid. This type of performance tends to last about a year from the start of a recovery, and then market leadership transitions to stocks with stronger fundamentals and higher earnings revisions. So, higher interest rate marks high potential, but negative profit tech companies make them less attractive because they need to borrow really to fund growth. This gets more expensive, and the higher guaranteed rates on government bonds become a better option for many people. Once the massive stimulus was passed on March 10th, markets took off again as we closed out the quarter. Now, I don't think that it's going to be smooth sailing, however, because inflation worries were another concern as we ended the quarter. With inflation expectations rising, treasuries are off to their third worst start to any year since 1830. So remember this, as yields rise, bond prices drop. What does this really mean for the upcoming months ahead? So in my view, markets will be hard pressed to keep reaching these new highs. As I mentioned earlier, the fourth quarter of 2020 was all about vaccines and reopening. The first quarter this year was all about stimulus and more reopening. What other major drivers can we really expect? So I am optimistic but cautious. I still believe we will see a strong first half of 2021, and the recently concluded first quarter will confirm that. But there are a number of ifs that could influence performance really in the second half of this year. So if fully reopening does not decrease new unemployment claims, if the administration or the Fed make policy mistakes, if inflation concerns turn into a reality, or if the market feels that current prices are not going to be supported by future earnings, we could be in for a very, very rocky second half. I think that there are more things that can potentially go wrong from here than can go right. We're kind of threading the needle. Bad news is ignored while good news is overhyped, and the market has a predisposition to lean positive. So that's emotion, and things can change very quickly. We need to look back at this time just last year with all-time highs. The markets will be on a hair trigger alert. And look, no one knows you like you. Only you and your financial advisor know your financial situation and your appetite for risk. So I cannot stress the importance of a proper positioning in your portfolio, plus a solid allocation and a plan that is really focused on your goals. You should remain focused on your long-term goals and not the daily and weekly returns that you see out there. There's going to be times when you're going to be stressed and you're going to be questioning yourself. That's natural. And it's always the case when you don't know something with 100% certainty. So then again, that's kind of the way that life works. We seldom make good decisions when we are under duress or lacking in knowledge. So we can control what we can control, including our expectations and our tolerance for risk. This is still a golden opportunity to reassess your tolerance and your risk and reallocate in a way that will cause you hopefully less stress and making sure that you're on the right track. So, with that said, visit with me and a member of my team. I can not only help guide you, but I can also assist in making sure that you are remaining focused on your goals. So, with that said, thank you, take care, be well, and I look forward to talking with you soon.